a major development has emerged that could reshape the future of U.S. monetary policy. President Donald Trump has officially nominated Kevin Maxwell Warsh, a former member of the Federal Reserve Board, as the next chair of the Federal Reserve. This nomination is not merely a change in leadership. Markets are interpreting it as a potential signal of a broader shift in the direction of U.S. monetary policy. So, who is Kevin Warsh? Kevin Warsh served as a governor of the Federal Reserve from 2006 to 2011. Before joining the Fed, he worked as a senior economic advisor at the White House during the George W. Bush administration, and later played a central role at the Federal Reserve during the 2008 global financial crisis. At the height of that crisis, Warsh was deeply involved in crisis response measures and in managing communication between the Fed and financial markets. In the private sector, he previously worked at Morgan Stanley in investment banking and mergers and acquisitions, and academically, he is a graduate of Harvard Law School. Today, he is affiliated with Stanford University's Hoover Institution, where he focuses on macroeconomic policy, monetary frameworks, and the long-term structure of financial systems. What does the market know about his policy stance? Historically, Kevin Warsh has been regarded as a hawkish policymaker. He has consistently emphasized the risks of inflation and has expressed skepticism toward prolonged monetary easing. However, analysts note that his more recent public remarks suggest a more nuanced position. Warsh has acknowledged that technological innovation and productivity growth could ease long-term inflationary pressures, and he has argued that the Federal Reserve's policy framework itself may require structural reform. As a result, Wall Street no longer views him as a one-dimensional inflation hawk, but rather as a disciplined policymaker with a growing awareness of economic complexity. Financial markets reacted immediately to the nomination. Following reports of Warsh's designation, the U.S. dollar strengthened while gold and silver prices declined. U.S. Treasury yields moved higher and risk assets, including cryptocurrencies, weakened. Analysts interpret this reaction as markets recalibrating expectations for future interest rate cuts, or even pricing in the possibility of a more restrictive monetary stance. Several U.S. investment banks have noted that Warsh's appointment could delay the timing or pace of monetary easing, thereby increasing short-term market volatility. At the same time, political concerns have resurfaced. Some lawmakers have raised questions about the independence of the Federal Reserve. Given President Trump's history of openly criticizing Fed policy, critics argue that this nomination could invite political pressure into the central bank's decision-making process. U.S. senators have already indicated that Warsh's confirmation hearings will closely examine his commitment to central bank independence. In summary, Kevin Warsh is a figure with deep institutional knowledge of the Federal Reserve, extensive crisis management experience, and a reputation for monetary discipline. His nomination is not just a personnel announcement. It is a moment that forces markets to reassess future paths for interest rates, the dollar, bonds, and global assets. The key question ahead is clear. Will Kevin Warsh govern the Federal Reserve according to his traditionally hawkish views, or will he adapt his stance to the evolving political and economic landscape? And how will that choice reshape global financial markets? The market is now standing at another critical turning point.